I'm Michael Fox, and this is the Prospector Podcast. And I have joining me once again, returning guest, Mike McGlone, Senior Commodities Strategist with Bloomberg Intelligence. Welcome back, Mike.
Thank you, Michael. It's good to be back.
Yes, and this is very timely. You are the third guest I've had this week. And what we're going to talk about today is the U.S. election, the big elephant in the room, pardon the elephant and donkey comparison. For the, what's going to come economically for commodities going into the future. As I've outlined with everybody previous, we are in a situation where this election is too close to call. We don't know what's going to happen in Congress. We don't know what's going to happen in the Senate, and we certainly don't know what's going to happen in the presidential race. So we're not here to handicap the election and make any projections. What we're going to discuss is the various outcomes that could occur and what's that going to mean for the commodities markets.
Well, that sounds good. I think the key fact of the election right now is there's very little risk of a peaceful, definitive transfer of power priced in. Of the lack of a peaceful and definitive transfer of power priced in markets. And that is S&P 500 is basically near record highs. Gold has recently reached record highs. We have a market that's basically priced for perfection, with copper breaking up around $10,000 a ton. It'd be nice if it continued to move higher. But we do have a month until the election. We're obviously recording October 4th. And that, to me, is one key thing for the next big trade. I think for a trade, initially, you probably have a little bit of nuance of risk priced into markets, coming into markets before we actually go to the polls in the States.
Yeah, given all this uncertainty and what's going to happen politically in the U.S., I found that really quite strange that the market's priced for perfection amidst all the chaos that could actually happen.
Yeah, it's a raging bull market. Risk assets only go up. The data we got today on unemployment in the U.S. has dropped down to 4.1%. Payroll strong. U.S. economy is strong. Certainly from that standpoint, but from a commodity standpoint, it's weak on a global basis, but that doesn't matter yet. So we'll stick with the first topic, and it's the election. I don't know what's going to happen, but overall, markets are just doing a great job of just going higher. And the problem is they're just so expensive. So I look at, let's say, the S&P 500 versus gold. It's the highest since about 2007. Now, gold has been ticking up lately. That's the problem I like to point out is gold on a one-year basis is up about 45%. That's beating the S&P 500 total return by 10%. The rock is beating stocks. So that's a bit disconcerting. It's starting to pick up. You look at the stock market, S&P 500 versus a Bloomberg commodity index. It's the highest since 2000. Look at it versus the MSCI ex-US index versus the rest of the world's equities. Basically, U.S. stock market's the highest in our database, which is about 45 years. So things are stretched. The question is at some point when we will get a little bit of reversion, and we're just not getting that. So that to me is like, I think the next big trade, and what I'm really worried about as a commodity person is I fully see that copper has bounced. That's great. But for it to continue high, you basically need U.S. stocks to go up. We see what's happening in China, potentially some strength of reversion continued in China, which I think is unlikely. And the key point is we've had even crude oil bounce, but crude oil's in a pretty significant bear market. It just bounced because of mostly geopolitical tensions. But overall, you look at crude oil, it's becoming much and more of a elastic commodity like the grains. They're still basically on their back foots. I mean, look at crude oil's basically down about 10% in the year. Most of the grains are down 10 to 15%. And all that was really led by natural gas, doing what they normally do. I'll end with this. I just reread a little bit of Adam Smith's Wealth of Nations, just about how commodities always gravitate to their cost of production. Well, we had that happen in U.S. natural gas. We have that had pretty close in grains. It probably have to get below to really shut off that excess of supply, particularly as South America starts to plant now. And we have started to do that in crude oil. I don't think the process is complete yet to get to that low price cure in crude.
No, and you talk a little bit about the geopolitics, and one of the concerns leading into the election day, which is, arguably just a little beyond a month away from where we are today, you have all sorts of geopolitics all over the world trying to take advantage of this lame duck period in American politics to wreak a little bit of havoc. There's issues with Ukraine and Russia continuing. You've got Xi saying that Taiwan's going to be part of China within the next 50 years. And you've got, Israel and Iran starting to toss some weaponry at each other. Is there any concerns of a geopolitical spike in the commodities happening between now and the transition of power in the U.S. in January?
You have to start with crude oil. I appreciate you going there because this is the foundation for commodities that for me, the world shifted on February 4th, 2022. That's the date that President Xi and President Putin announced their unlimited friendship. Reminded me a lot of what I read about Molotov-Ribbentrop right at the onset of World War II between Germany and Russia back then. And I want to point out, since that date, February 4th, gold's up about 50%. The S&P 500 total returns about 30%. So gold's beating the rock. I mean, the rock's beating stocks by about 20% since the world order shifted on that date. And the Bloomberg Commodity Index is down about 10%. So to me, what's happening is we're seeing a major shift in the world order that's kicking in the natural reversion of a rapidly expanding emerging market that grew too fast, i.e. China. And it's happening fast. Now they are stimulating their economy. They have to. It's a key thing to remember. And let's not get too bullish about these things because this is things that most commodity traders have been waiting for a while. Now, as far as the initial question about geopolitical tension potentially in the next month or so before we have a transfer of power in this country, sure, that's always a risk. But to me, it's the macro. It's overwhelming. The Cold War 2.0 is heating up every day. So right after we had the unlimited friendship, we did see Russia's invasion of Ukraine. That's been bogged down. It's supposed to be done in 2 weeks. That's not working. And then we're seeing emboldened axis of bad guys. And now you see Iran, North Korea, and Russia. Now we're seeing what's happening with Israel and Iran lately. A lot of that, the whole foundation comes down to what was a former good trading partner with the U.S. turning into a key enemy. That was their decision. And the quote from NATO about China, as far as the war in the Ukraine, was decisive enabler. So to me, that's the macro. That's overwhelming commodities. It's still bullish for gold. It's bearish for crude oil, partly because we're seeing what's happening. Anytime you have any major oil producer go to war, which we've seen with Iraq and Iran, was one of the best examples. They produce as much as they can to support their war spending. So I still think it's a very bearish factor for crude oil, particularly as we see crude oil demand declining in China. Total imports from China of crude oil is about 11 million barrels a day. Now, that's the same as 4 years ago. That's never happened. In certainly the last 30 years, that we have stagnant demand out of China, yet we have excesses of supply growing from the U.S., Canada, and OPEC spare capacity. So that's the bear market for crude oil. And then we also have this massive amount of deflationary forces coming out of China. Just today, we saw the European Union tack on 45% tariffs on Chinese imports of automobiles. The U.S. did tacked on 100% tariffs back in May of Chinese EVs. And why? Because they have to. Because the deflationary forces of the massive overproduction of EVs and renewables and virtually every product out of China is accelerating. Why? Partly because they put their whole fault and credit of President Xi behind it, which is deflation on a global basis. And that's part of what I think is happening. The automakers, you see what's happening in Germany. They have to push back or they're going to get crushed. In the U.S., they have to push back on these cheap imports or they're going to get crushed. And it's just a question, where does it go from here? So I look at it as, unless we have some kind of shift to back towards favorable status with its best export customers, which is Europe and the U.S. from China, I should say no. I respect China and its history and its future and all its citizens. From one person in China, the autocratic leader, unless we have some substantial shift away from that unlimited friendship with the former Soviet Union, with those of us all remember the Cold War, that was the main enemy, then these trends I think are going to go accelerate. This is the bottom line. I'll end with this. The Cold War 2.0 is heating up every day, and I don't see any sign of that stopping.
No, and let's stay on the topic of tariffs. And move towards the actual presidential race and discussion. You've got two presidential candidates who are arguably are both pro-tariff, one more so than the other. The reality is, former President Trump kicked off the trade war with China by, leveling mucho tariffs on the Chinese exports. But the Biden administration, which Harris has been a part of, has not really done anything to rev those back. And as you pointed out, they dropped 100% tariffs on Chinese vehicles. And President Trump, former President Trump, rather, has stated very openly he wants to increase tariffs. Are we potentially heading into another Smoot-Hawley situation like we had in the 30s, where tariffs basically kill the economy and the demand for commodities?
I appreciate you going there because that is a key risk. I did just finish H.R. McMaster's book. He's a former NSA head of the National Security Advisor for President Trump. His book was called At War with Ourselves. I thought it was a very good outtake, very fair and unbiased view of what's happened and is going to be happening. And his key take is Chinese are afraid. And they should be, because what's happening and what they started to do. So the what's happening there is, let's put it this way: we can virtually guarantee if President Trump is elected, we'll see drill at will. We'll see pressure on crude oil prices. Virtually guarantee we're going to have tariffs, he said that, which is probably, I think, overall pressure in the dollar. He's made that statement, which is good for gold, bad for crude. The thing is, it would accelerate pre-existing trends. That's why it's so significant. Him getting elected, the most significant trend in commodities is gold inflation, most commodities deflating, with copper kind of in the middle there. So if he's elected, I think it would accelerate those trends, and you'd say with reason. So that to me is the key risk that's going to happen. And obviously my bias is I think it's more likely that we'll have the first female president in this country. But again, that's just my sense of where things are leaning. But overall, if he's elected, that would happen. Now, if President Harris is elected, the key thing I think will be about we still have a major issue with the deficit. And I think the number one way to really solve this unlimited spending in the U.S. is to have a split legislative and executive branch. The last good example of that in deficits declining and actually having a surplus was when Clinton was president. And remember, we had the more Republican-dominated legislative branch led by Newt Gingrich. So that is something I think most of us, I was at a conference yesterday in Naples at Family Wealth, and I thought, well, that might be the only way to really help this unstoppable deficit. But that's part of what's, either way, that's really keeping a bid under gold. So I don't see what stops gold from going up other than maybe some back and fill of a little bucking of the bull. We're overdue for that. But overall, the next election should be quite interesting. And I think, and I point out, if Trump's elected, I think it's good for what's already happening in commodities, and that's gold going up and crude oil going down.
We talked about the commodities. The one we left out of that conversation was the silver market, in that it has some elements that look like a precious metal like gold, and other elements that makes it industrial like copper. What do you see happening with, say, the silver market specifically, since we kind of touched upon all the other commodities?
I appreciate you going to gold silver, because gold silver is something I've enjoyed watching that spread forever. And at 82 ounces of silver per ounce of gold, it's kind of stuck in a narrow range, but it's been going up since you look at 2011. The low was around 32. So it's doubled since then. The high at COVID was just above 120. I think silver is going to continue to underperform gold, and most notably on a volatility adjusted basis. So on a 1 year basis, gold's up 45%, silver's up 53%. But silver typically is called leveraged gold. It typically trades at least 1.6 times the volatility of gold. And typically if gold's up 40 to 50%, silver's up more 70 to 80%. So it's lagging on a volatility adjusted basis. The gold silver ratio at 82 is, I think, more likely to go higher, but there's key things that really boost that. And I think silver has been demonetized by gold for hundreds of years, and certainly more so than ever. It's much more of an industrial metal every day now. It's much more when you talk about silver, it's solar comes right. I mean, it used to be photography, now it's solar, and the electrification trend. So, to me, the key issue I'm worried about is if we have continued reversion of the Chinese economic miracle and growth, which I fully expect. And that to me means it's much more likely that the gold silver ratio, which has been going up forever, is more likely to continue to advance, particularly if we have bottoming U.S. stock market volatility, which is very subdued. 100-week, 200-week moving average of the VIX is the lowest in 6 years. Looks like it's rolling back upwards. And if we have continued rising unemployment in the U.S. and continued disinversion of the yield curve, typically that means the gold silver ratio will continue to advance. So silver $32 an ounce is doing what it should do, with gold making record highs. The problem is I think it's just tracking on back of beta going up and the stock market going up, and China, just the recent bid in copper. I think the greater risk is we have a little bit of back and fill in the U.S. stock market, maybe a bit of more declining of Chinese economic growth, which means gold still continues and maybe outpaces silver on an accelerated basis.
Okay, so let's take a look at you talked about electrification. Let's take a look at that green economy. You can't have two groups that are more opposite each other on a topic than I think on the green economy and electric vehicles and electrification. What do you see happening there if I assume that it's game on and same old if Harris were to win. But if former President Trump were to win this election, he's talked about getting rid of windmills, putting high tariffs on solar panels, getting rid of electric vehicle subsidies. Does this cause a slowing of that green energy revolution, and does that put some headwinds onto those commodities?
Oh, absolutely. I think that's a good point to go there. He has pointed out he will rescind the IRA, the Inflation Reduction Act, which means mostly renewables. But we'll see if that's obviously if he's elected. But I think the thing is, it's just what happened with cryptos. It's what happens typically with incumbents like him, who, according to H.R. McMaster, are contrarians by nature and just reject things like rapidly advancing technology that makes a difference in the world. It's the way he pushed back on cryptos 5 years ago. I enjoyed writing about every single American legislator at some point is going to figure out what I've been writing about for 2 years. This space has gone for the dollar organically. What American would push back on that unless they don't understand it? And that's what he didn't understand it. But now that he does and he wants to get elected, he's really been favorable to things like cryptos. To me, that's the same thing with all this rapidly advancing renewable technology and renewable things like that. As I just go by that great Canadian Jeff Booth, what he wrote about in his book, The Price of Tomorrow. Technology is moving so fast, to push back on it is just silly and somewhat, some people might say stupid. But so he'll push back in the short term to get elected, but it's overwhelming. That the force of, I had solar in my house. My EV is 10 years old. The significance of that 10-year-old plug-in hybrid EV is I can get the same car from China, if I was allowed to, at half the cost with almost 4 times the efficiency come from my vehicle that's 10 years old. That's just shocking. And that's just where things are going. Just, to be able to drive 1,300 miles on a full charge and a full tank of gas is unheard of. But for half the cost of an existing U.S. automaker, you can stall that, but you can't stop it. It's just what's happening. So I don't know how long it lasts, but it's just a question of, it's an overwhelming force for deflation. And I like to narrow it back to commodities for deflation of petroleum prices. Petroleum is being replaced by both technology on both sides, increasing supply, reducing demand on both sides. You look at unleaded gas, diesel demand in this country are declining. And even in China, I'm hearing there's signs of diesel demand China declining, partly because they're shifting a little bit over to LNG. But the overall fact is that the technology is overwhelming. It's silly to push back on it. Maybe it's just not smart to push forward too aggressively on it, which is maybe what a new Trump administration will be pointing out, because it's part of rapidly advancing technology that shifted the U.S. and Canada from net energy importers to net energy exporters over the last 20 years. Do we want to mess with that? We don't have to go to wars in foreign countries to secure our oil supply. That would just be kind of silly.
Yeah. Now, let's stay on the electric vehicle topic here as a model. Both presidential candidates have a different vision of how to reindustrialize America in a lot of ways. Donald Trump wants to create a sovereign wealth fund, very similar to what the Saudis and the UAE has, and places like that in the Middle East, where Vice President Harris has talked openly about creating strategic reserves of critical metals, very similar to what's been done with oil and more recently uranium. Are either of these plans workable, or is it something that it's a pipe dream, or is it a combination of both these things? And if we're going to create a critical reserve of commodities, is that going to push commodity prices up?
A critical reserve of metals that help sustain the security of the United States makes logical sense, as much and more so than as much as the Defense Department and as much as the SPR, the Strategic Petroleum Reserve. But making statements that we're going to have a wealth fund and going into accelerated deficit spending for that would be considered by most rational economists and people as just irresponsible. So just pointing out facts of our deficit spending right now, that's something that the next president, next leaders have to adjust. And saying we're going to borrow more to from our taxpayers to invest it is just silly. So it's a nice statement. I think it gets votes, but when you really dig into the fact that we have sovereign wealth funds in countries that have surpluses, and you have to do something and be responsible with it. We don't. We have a deficit in spending. We need to fix that first. I mean, come on. We know how logical it is. So, but so that would be somewhat bullish for critical metals, but very not bullish for anything that's really widely traded. Widely traded futures and metals top with gold. There's silver. There's obviously copper. Iron ore is even less so. It's metals that most of them I won't even attempt to pronounce, but are really important to defense and certainly important to EVs and a lot of rapidly advancing technology, particularly iPhones, things like that. So that makes sense. But the thing is, remember, is we've been importing a lot of those commodities from China because they're cheap, and partly because they don't follow a lot of the strict environmental rules that we have in the U.S. I mean, you can bring on some supplies of metals in China in just a couple of years, from what I've heard from my colleagues in Bloomberg and New Energy Finance. And the U.S., Canada, and most of the rest of the world takes minimum 10 years with regulation and stuff. But let's remember, U.S., Canada, Mexico, North Carolina, massive continent of land, particularly the amount of things I heard that the Defense Department, the Energy Department now is being able to get from just coal, excesses of coal, that they're digging into some of the critical metals from there. It's just the technology will be fine. But as far as boosting the main metals that matter to me, I think it's unlikely. And it'll just be over time. So let's end with this. The best trade from a president in terms of commodities ever is something I pointed out 2 years ago when President Biden ordered the release of the SPR. Just the fact of what he did, crude oil is above $100 a barrel. We released it all. You can buy those back now, $70 or so a barrel. And I pointed out at the time that net gross income was about $20 billion. And if he had bought them back and just buying diverted futures that were severely and steep backwardation, I mean, those diverted futures were lower prices, we could have netted $5 billion and we would have already made delivery on those by now. But now, by holding off, he's netted about $10 billion. It's just kind of silly. But here's a fact. I'll point with this. The U.S. Strategic Petroleum Reserve was necessary as a safety for the safety of the country. It was set up to cover 90 days of net imports. Now, the U.S. and Canada right now have net exports of crude oil and liquid fuel near 6 million barrels a day. To put that in context, in 2008, when crude oil peaked at about $145 a barrel, it was a deficit of 10 million barrels a day.
Yeah, it's kind of interesting. You trot out these plans, but you have to take a long, hard look at where the rubber hits the road. If they're actually feasible and will actually accomplish anything. Is there anything else at a presidential level that's been said or stated by either candidate that you think is going to have an impact on the commodities going forward?
I think you've touched on the main things. The main things that we hear that would be if we have, I think it's considered more similar of more kind of a fluent transition if we do get the first female president like Mexico did. And it's be a bit of a shakeup, obviously, again, going back to if Trump is reelected. But we've seen what's happened. Now, you did mention he started that trade war. Mr. McMaster pointed out, and as I agree with, that was way overdue. So a lot of his policies, Trump's policies, have been adopted by both parties. So he's already done his duty, I think, without being so abrasive, and we can avoid some of that, to merely shift some of what his focus was. It's now the key thing is if he's reelected, that would be the key thing I point out. To me, the maximum thing I expect is that we would have a bid under gold and an offers above in crude oil, which the key thing is those are pre-existing trends, and the risk is they would accelerate. And those to me are the key factors in commodities. And then the dollar. I think the key thing that I keep hearing from the dollar. I had a colleague who wrote a book, Paper Soldiers was the name of the book. I forget her name, and just pointed out how virtually anything that Trump did was very negative. And pushing back on the Federal Reserve is really negative for the dollar, and pushing for lower rates. And actually stating he wants a lower dollar is also another factor that's good for gold and overall commodities, but typically it's not really so much crude oil, it's more gold and copper.
In the early part of this conversation, you said that the markets are priced for perfection. And I guess a perfect outcome for this election would be that both houses and the presidency would sit within one party, and an agenda that party is proposing would be, easily passed through and maneuvered through Congress. Not likely to happen. We currently have a narrow majority split by both parties in both Congress and the Senate. That doesn't look like it's going to change. So we could end up with a split house again in the U.S. And that doesn't seem to be being priced into anything, is it?
No, not exactly. So it's just like a very simplistic measure. I look at the S&P 500 versus its 100-week moving average. Right now, it's 23% above that level. In the last 30 years, that's only been able to sustain above that level for more than like a couple weeks or just a month. And the last most significant example was bubble peak, 1970, basically near the top peak in the 90s, it was like 98 or so. And then the biggest money pump in history in 2021. So we're very stretched in just a normal measure. It will always return to that level or the level will go to prices. So that's priced for a lot of risk. And I just think at some point, a little bit of normal reversion in the stock market is not priced in anywhere, except where I'm seeing the indications are in Bitcoin. I like to look at Bitcoin as a tremendous leading indicator. It's the most widely trading risk asset on a 24/7 basis. It's been showing divergent weakness versus gold, versus S&P 500 for months now. So to me, that's my indication that, we're overdue for a little bit of correction. And here's the key thing I'll end with, Michael, and that is one of the key indicators that made me a lot of money in 2008 when I was a trader, basically just hedging, and that was volatility in the U.S. stock market. When the VIX volatility index, the 200-day, was basically I'm looking at the 200-day moving average. It is just starting to bottom from the lowest level in 6 years. When you see volatility starting to rise and come from a very low subdue, there's a lesson in volatility. It's always mean reverting. If that continues to rise, which I think it will, but again, where it's coming from, that's a good indication for risk assets for normal reversion. So I look at this as the next big trade, I think, in the market is, okay, price a little risk for an election, see what happens with the election, and then see at some point if we do revert. And I'd like to end with this one key fact. At about $60 trillion, the U.S. stock market cap to GDP is about 2x. That's the highest in about 100 years. Now, maybe that doesn't matter anymore. I hope it doesn't. What we saw today with strong unemployment on October 4th is a sign that, it still doesn't matter. But if you look at the history of the unemployment rate in the U.S. at 4.1%, bottomed at 3.4%, it's never bottomed from that low without going to 6%. So my point is the biggest risk, I think, in markets is normal reversion, which keeps me still bullish gold, bearish crude oil, and very concerned about risk assets.
Wonderful. If people want to follow your advice and your analysis, how is the best way for them to do so, Mike?
On your program, thank you very much for having me. I post on LinkedIn, Mike McGlone, Senior Commodity Strategist, and on Twitter at Mike McGlone 11. And thank you for having me on, Michael.
Not a problem. It's interesting times for sure. And over the next 6 months, while this all sorts itself out, I'm sure we're going to see a lot of things we weren't expecting. So there will be plenty for us to talk about.
There you go. Plenty for us to talk about and write about, and we just hope it's not too much painful for the masses.
Absolutely. Thanks again for coming on.
Thanks for having me.
The Prospector News Podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.